Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar on core options concepts, we'll start with the building blocks of options trading, including rights, obligations, assignment, exercise, and premiums. As always, we'll cover the material, as well as your questions, in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you, and investors like you, with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Understanding Core Options Concepts. Joe?
Nick, thanks so much, and thanks to everybody for joining us today. We got building blocks, we've got core concepts. To me, it just doesn't get any better than that when we're talking about options education. I mean, there's nothing more important than having a solid foundation to give you the confidence to move forward with the use of options. So let's get started. You know, the industry, of course, does have this document called Characteristics and Risks of Standardized Options. It basically gives all kinds of different informations on the listed product, and it emphasizes that options do have risk and are not for everybody. So you should probably already have a copy of that. You can get that from the OCC or from any of your brokers. Typically, about 30 to 35% of us who join us each webinar, and that's many hundreds of you, are typically first-time attendees to an OIC event. And so I like to go through slide 3 and 4 in a little bit of detail for these new folks who are joining us. This slide, who we are, speaks to the different exchanges who help make the OIC happen, as well as the clearing corporation in the lower right-hand corner, the OCC. So the OIC was founded in 1992, and all the while has been funded by a combination of the members of the OCC, the clearing corporation, as well as the various exchanges, which now count 12. We have 7 parent companies and a total of 12 exchanges. And real quickly, BATS, that's an electronic exchange out of Kansas City. We've got the Box, another electronic exchange out of Chicago. Also, CBOE, the first exchange, and its secondary exchange, the electronic exchange, C2. We've got the first electronic exchange, which was the ISE. I'll speak about that a little bit more in the next slide. We've got its other exchange, ISE Gemini. The MIAX is the latest offering of new exchanges. You've got NASDAQ BX, NOM, and also NASDAQ PHLX, which is where I spent the vast majority of my career. And then the New York Stock Exchange has both the Amex and ARCA. ARCA being the old Pacific Exchange. This slide here, for you repeat attendees, know that this is one of my favorites. It's basically a snapshot of industry volume from inception, going back to 1973, when the first listed options were traded on the Chicago Board of Options Exchange in April of that year. I'm pretty sure there were 16 different companies that had options listed on them back then. And by the way, there were no puts. Those options were calls only, and that was the case until we get into the late 70s. So we started with 16 companies with calls only, and as you can see over time, volume started to grow, albeit rather slowly. Those numbers on the left-hand side of the chart there, that first one, 0.50, represents the volume for the year, and that 50 represents 500 million contracts. So you can see it was, from between 73 and 1999 that the industry had not exceeded 500 million contracts for the whole year. If you move forward and you take a look at the bar representing 2011, we had a spike in that year, especially in August of that year when the U.S. lost its AAA credit rating. The industry did over 500 million contracts that month alone. And obviously the industry has grown dramatically, both in the number of exchanges and listings. We've now got in the neighborhood of 4,200 listings, and that includes individual stocks, ETFs, and indexes. Last year, the industry did just over 4.3 billion contracts, which came out to just under 17 million contracts trading per day. So that's a little bit about the history. We're going to get into lots of, as Nick said, building blocks and core concepts today, and then, of course, we'll leave time for your questions. I really enjoy talking about the building blocks of options, so let's get at it. We're going to, review essential concepts, some of the terminology and mechanics. We'll talk about buying calls, buying puts, selling calls, selling puts. We'll get into option premiums, specifically in the money, at the money, and out of the money options, and then we'll wrap things up before questions. So some of the terminology and mechanics that we go through, and this is a slide actually that I just put together because I believe so strongly in it, and that's the whole idea of understanding options. My strong belief is that when starting out, the fundamental concepts and terminology, in the options language can be very confusing, but really it's not really that complicated. So I urge you, and this is, more of a basic webinar than we typically offer, be patient in gaining options knowledge. Review the concepts, give yourself some time, and I'd like to promise that before too long, a lot of these core concepts and building blocks will kick in and give you the confidence, if you decide you like options, to move forward and use them. So options, they are tools, and really investors, both professional traders, retail investors, use options primarily for two reasons. There are other reasons, but primarily to generate income and reduce risk, especially in this low interest rate environment. The whole idea of generating income has led to more and more investors using the listed options product. And as we use options and we go through some of the different characteristics here, we'll see that there are unique trade-offs. So what are options? Options are contracts. They're contracts that give the buyer of the option the right to buy or sell the underlying asset. And by underlying asset, we're talking about that stock, index, or ETF. So options are contracts. If you buy the contract, you get a right. And depending on whether you're buying a call or a put, that right is to buy or sell the underlying asset. And on the sell side, we take on obligations. And that obligation can also be to buy or sell the underlying asset, depending on whether we're selling a call or a put. And each option is done at a certain price, and that's called the strike price. We'll talk more about that, and within a certain time frame, because as we know, options do expire. Early on, Nick talked about rights and obligations. So these option contracts give the buyer the right, and when you're buying a call, you get the right to buy that underlying stock, index, or ETF. If you're buying a put, you also get a right, but the right is the right to sell the index, stock, or ETF. And that's where sometimes the whole idea of protection and again, protecting a portfolio or an individual stock can come in with the idea of purchasing puts. So that's the buy side. Buyers have rights, sellers have obligations. A call seller has the obligation to potentially sell the stock, index, or ETF, where the put seller has an obligation to possibly buy that stock. And each option does correspond to 100 shares of the underlying. So that's also where the idea of leverage comes in. As mentioned, at a specific strike price at any time before expiration. Two types of options we've talked about: calls, puts. Each option contract basically corresponds to 100 shares of that underlying, whether it's the stock, index, or ETF. Again, the equity call buyer has the right to buy 100 shares of that stock. You know, the lingo in the business is you buy that contract, you're long the contract. Whether it's a call or a put, I'm a buyer, I'm long the contract. Equity sellers, as we've mentioned, have the obligation to potentially sell 100 shares. The equity call seller has the obligation to possibly sell 100 shares of that underlying stock. The lingo there is I'm a seller of calls, I'm short the call, also known as the writer of the call. Put side, okay? Equity put buyers have the right to sell that underlying stock. Same lingo, long the put. The equity put seller has the obligation to possibly buy the underlying stock. Again, same idea, you sell the put, you're short that put contract, also known as a writer of the contract. So holders are the buyers of options. Long calls, again, give you the right to buy the underlying. Long puts give you the right to sell the underlying. Writers or sellers have a short position, and call sellers, their obligation is to potentially sell the stock, where the short puts or the put sellers have the obligation to possibly buy the stock. Other contract terms for each option contract, of course, we've got the underlying stock, which is contract specific. We mentioned 100 shares per contract. The all-important strike or exercise price, as well as the expiration month. Additionally, I mentioned early on, there are about 4,200 underlyings where we list options on the 12 exchanges now. In addition to monthly contracts, about 10% of those contracts or underlyings also have weekly options as well. And as I think we're all aware, unlike shares of stock, these options do have an expiration date. So more important terminology is the strike or exercise price. I can't emphasize how important that is. Okay? That strike price is the price at which the underlying may be bought or sold. So let's, a little bit of an example. XYZ, the December 45 call, trading at $5.50. The underlying, in this example, would be XYZ. The DEC 45 call, trading at $5.50, would, of course, equate to 100 shares of that underlying, and depending on whether we're buying the call or selling the call, we're either going to have the right to buy the underlying or the obligation to sell that underlying. The expiration date in our example is going to be December. the premium is going to be $550. As we mentioned, each contract corresponds to 100 shares of the underlying, so we take that 550, multiply it by 100, which means each option contract is going to have a price or premium of $550 plus commissions. Option expiration is the third Friday of the month if we're talking the standard monthly options. The weeklies are listed on Thursday and expire the following Friday. And as I mentioned, that's on just over 400 individual listings. If that Friday happens to be a holiday, the last trading day for the options at expiration would be Thursday. In terms of understanding the rights, okay, exercise is the right that the option buyer acquires. And if we exercise the call, the buyer essentially is choosing to buy the stock at the strike price. So if we go back to that previous example, XYZ deck 45 calls, if we exercised the deck 45 call, that would give us the right to purchase 100 shares at $45 for each option we owned. On the put side, the put buyers, we know, have a right as well, but their right is the right to sell the stock. So if we go back to that deck 45 and we decide it's a put rather than a call, if we exercise that call, or excuse me, that put, we'd have 100 shares of short stock because we'd have the opportunity in exercising that put, we would be selling 100 shares of stock at the strike price at 45 for every option that we were long. So that's the exercise side of the equation, and the exercise side comes with the right. The right is to potentially buy or sell the underlying, and if we evoke that right, we exercise the option. That's on the buy side. Now, when we did talk about selling calls and selling puts, the buyers have rights, sellers have obligations, and when an option is sold and then assigned, the seller of the option has to deliver on their obligation. And when a call seller is assigned, they have to deliver short stock at the strike. So if we go back to the deck 45 calls, if the short seller or if the call seller is assigned that 45 call, for each option they're short and assigned on, they have to deliver 100 shares of short stock at $45. That's, short calls. If the put is assigned, and you can only be assigned when you're short the option. Again, on the exercise side, the buyers have rights, and their right is to exercise. Option sellers have obligations, and that obligation can be assigned or an assignment. And so the situation with the put assignment is when we sell a put, we potentially have the right to buy the underlying at the strike. And in this case, it would be buying the stock at $45 for each put we're short. Let's talk a little bit about option premium. An option buyer, as we know, pays premium. That price is essentially non-refundable, but it's a price that we can turn around and sell and therefore get some of the price back, either at a profit or a loss, depending on whether the value of that option has gone up or down. An option seller receives premium, and seller gets to keep that premium whether the price of the option goes up or down. The price does fluctuate. So option buyers pay a premium, option sellers collect a premium, and the price of those premiums does change over the course of time up to expiration. depending on whether the stock moves, whether it goes up or down. And the premium, as I mentioned, is always quoted in basically hundreds. Each contract we multiply by 100. So in our example, we've got a $3 option. We'd multiply that by 100, and we'd have a price of $300. Our earlier example, we had a $5.50 option. We'd multiply that by 100, and the value of that premium would be $550. So we're going to talk a little bit about some of the calls and puts. We've got in-the-money calls. In-the-money calls are calls where the stock price is basically above the strike price. In-the-money calls have intrinsic value, and we'll get into an example with that. If we take a stock price that's $62 and we've got a $60 call, the $60 call represents the opportunity to buy stock at 60. And with the stock at 62, that call would have $2 of intrinsic value, or in the money amount. So that's an example of a call that's in the money. In the money puts, on the other hand, the stock price is below the strike price. The in the money puts do have intrinsic value. Any in the money option, whether it's an in the money call or an in the money put, it does have intrinsic value, so it's got an in the money amount. Let's take a look at an example on the put side. If we take a 60 put, that's the right to sell stock at 60. If the stock is 58, that put is $2 in the money, so it's got $2 of intrinsic value. At the money calls and puts are just what they sound like. They are options where the call and the put are right at the money, so the stock price equals the strike price. And because the stock price equals the strike price, there is no in the money amount, and therefore no intrinsic value with these options. If we had a stock that was $60, the $60 call and the put would be at the money. And then our out of the money calls, that's an option where the stock price is below the strike price. Out of the money calls and puts do not have any intrinsic value. An example of an out of the money call, let's take a stock price of $63. If there's a call at the 65 strike, which gives us the right to buy stock at 65, and the stock's 63, that 65 call is $2 out of the money. On the put side, out of the money puts, and it can get a little bit confusing, but the out of the money puts, the stock price is above the strike price. And because the options are out of the money, whether it's a call or a put, just by the name we know there is no intrinsic value. So an example, if we had a $68 stock, that 65 put would be out of the money by $3 because, again, the 65 strike would be $3 lower than the market price of the stock at 68 bucks. So we've got intrinsic value and time value. When we're talking about option price, let's take a $56 stock with a $50 strike call option that's valued at $8. So the stock's 56. The 50 strike call is worth 8. Okay, it's the 50 call. The stock's 56. That 50 call represents the right to buy stock at 50. With the stock at 56, we've got $6 of in the money amount or intrinsic value, but the value of the option is $8, leaving us with $2 of time value. That's basically how this works. Again, if you're just getting started, sometimes it can be a little bit confusing, a lot of different terms, but it really is pretty straightforward. The time value equals the total premium minus any intrinsic value. So if we had a $60 call, again, our stock price here is $56. If we had a $60 call priced at $2.10, is there any intrinsic value there? Well, stock's 56. The call is the 60 call, the right to buy stock at 60 with the stock at 56. That's going to be out of the money by $4. So if it's out of the money, means there is no intrinsic value, and the time value is going to be whatever the total value of that option is, which is $2.10. So that's basically, how this particular example works. Let's do a quick quiz. Intrinsic value and time value. Left-hand side at the top, stock price 78. The 70 call, does it have intrinsic value? The total option price is $10.50. So intrinsic value, the 70 call, the right to buy stock at 70 with the stock at 78, hopefully you think there's $8 of intrinsic or in the money amount. Hope that makes sense. Option price is $10.50, so the difference between the 8 and the $10.50, we get $2.50 worth of time value. How about $36 stock with a $35 call? In the money, I hope, by $1. So we've got $1 of intrinsic value. The value of that option is $3.70, going to leave us with $2.70 of time value. $43 stock with the 45 put. Okay, the put, what is that now? That's the right to sell the stock at 45. The stock at 43, we've got $2 of intrinsic value. Hope you get that. Total value $3.50, going to leave us with $1.50 of time value. $50 stock with a $50 call, clearly at the money. Do at the monies have any intrinsic value? Absolutely not, none at all. The price of that option is $1.50, so that leaves us with $1.50 of time value. Stock price $33.50, the 30 put. Option to sell stock at 30 with the stock $33.50. No intrinsic value there because that put is below the price of the stock, so there's no intrinsic value. And the value of the option is $3.50, so all $3.50 is time value in that particular example. And finally, the stock price 27, the 30 put, price of that option is $3. Intrinsic value, I hope that's what you said, $3. That's the total price of the option, so there is no time value, which can sometimes be the case. Maybe expiration's this afternoon, maybe it's tomorrow, maybe that's why there's no time value, or maybe that option is so deep in the money, not the case with a $3 option. But maybe there's just no time value to that particular option. So that's a quick quiz. I hope that you did pretty well with that and made some sense to you. If not, no problem, because this stuff at the beginning, as I said early on, can be darn confusing. So what's in, what's out? In the money, the call, stock price is above the strike price. The puts, the stock price is below the strike price. Out of the monies. Okay, that call, for an out-of-the-money call, the stock price is below the strike price, and for a put, the stock price is above the strike price. At-the-money calls and puts are just what they seem. The stock price is equal to the strike price. But I think more than the words, I think going through an example is by far the best way to learn this. So let's do one more quick quiz. Ins and outs. Stock price 55, $60 call. In, well, it's clearly not at the money. We know what at the money would be the 55. So it's either in or out of the money. With the stock price 55, that 60 call is $5 out of the money because it's the right to buy the stock $5 higher than the price of the stock in the market right now. Next example, stock price 33. The 35 call, the right to buy stock at 35 with the stock 33 is $2 out of the money. Hope you get that. Stock price 77, that's 75 call, the right to buy stock at 75 with the stock 77, $2 in the money is right. And finally, the stock 25, that 30 put, the right to sell stock at 30 with the stock 25 is $5 in or out of the money. In the money is correct. So not sure how you did with them. Maybe you can let Nick know, in the little chat box whether you did well or not with those couple quick quizzes. So let's take a look at calls and puts, and then we'll get into buyers versus sellers. Calls. Why get involved with calls? Well, typically investors use calls when they're bullish on an underlying, and oftentimes we want to take a position without tying up too much cash with predefined risk, and that's what a long call position can do. Let's take a look at an example. Again, XYZ, our favorite stock here at OIC, trading at $60. We're bullish on the underlying, and we do want limited risk. So we can get limited risk when we buy an option because we know that whatever we pay for the option is the most we can lose. So it's a $60 stock. We think the stock's going up. We decide to buy a 3-month 60-strike call for $3. So if it's $3, you multiply that by 100, and it's going to be $300 for the option contract. So here's how it looks on a P&L chart, and that 55, 60, and 65 represent the price of the underlying. We bought the 60 strike, okay? We bought the 60 strike call, and that's the right to buy stock at $60. Our break-even point is not going to be 60. It's going to be 60 plus whatever we paid for the price of that 60 strike call. So it's 60 plus the $3. Our break-even is going to be $63. So the stock can, and when you buy an option, it doesn't mean you have to hold it to expiration. You can buy and sell the option at any time in between. With the stock at 60, the stock we know at expiration needs to be above 63 in order to make a profit at expiration. But we've got 3 months of time. If that stock were to go up, a point or two long before expiration, chances are the option would have, appreciated beyond that $3 we paid. So let's take a look at different stock prices versus the $3 premium we paid for the 60 call, which again is the right to buy the stock at 60. Now, it's hard to say what the investor's forecast was here. We just said generally that the investor was bullish on XYZ and the stock was currently at $60. So if the stock went to $70, okay, the stock was 60, and it at expiration goes to $70, the value of that 60 call is going to be $10. What does the 60 call represent? It represents the right to buy for the buyer. It represents the right to buy 100 shares at $60. Well, if the stock's 70, clearly that option is worth $10 minus the $3 we paid. So we'd have a whopping $7 profit on that $300 investment. Okay? If the stock was 65, I hope you get that the value of that option at expiration is going to be $5. We paid $3. We'd have made, $2 or $200 on that trade. So at 60, what do you think the value of that option is going to be at expiration? Well, at 60, there is no value to the option. We paid $3, so we'd have lost $300 or $300 on that particular trade. And then, further on down, no matter how far down we go, in our example, it's either 55 or 50. Of course, the value of that 60 call is going to be 0, and therefore we'd have lost all the premium we paid for that option, which in this example was $300 or $300. If the stock had gone out at 61 at expiration, okay, the value of that option would be $100 because What did that 60 call represent? Well, it represented the right to buy stock at 60. With the stock 61, it's worth $100. If we paid $3, at 61, we'd have lost $200, not the full $300 we paid, for the 60 call. So that's basically how these things work. Take a look at a little different example. We got XYZ, a January 50 call priced at $2.20. XYZ, of course, is the underlying stock corresponding to 100 shares of the underlying if exercised. January is the expiration month, and expiration would be that third Friday. 50 is the all-important strike price, that price at which we have the right to buy the stock if we're a buyer, and the right to sell the stock if we are a call seller. Another option example, the XYZ Jan 50 calls at 220. In this same example, we're talking about a call. That's the option type versus a put. And then, of course, the premium is going to be 220. That's that 220 times 100 for a total price of $220. So the long call, the whole idea of the long call, importantly, we really haven't talked that much about risk because we're talking about building blocks and core concepts. But around these core concepts and building blocks, as you grow in your option knowledge, it'll always come back to how much risk am I taking, how much risk am I willing to take. The whole idea of risk is always very, very important. On the long call side, we have limited risk because our risk is whatever premium or price we pay for that option, and our profit potential is theoretically unlimited because theoretically, a stock price can go to infinity. So limited risk, unlimited profit potential on the long call side. On the flip side, the short call side, it's a whole different scenario. Short call, what are we talking about? We're talking about selling a call, so maybe selling that call for $5.50 or selling that call for $2.20. The most we could make, as the graph shows, is that horizontal line above the 0 point. The most we can make is the premium we sold that option for, but when we're talking about selling a call, we're selling the potential obligation to sell that 100 shares for each contract we sell at the strike price. So if the stock goes from 50 to 100 and we've sold a 55 call, we're in a lot of trouble because and if we've just sold the call, the value of that 50 call with the stock at 100, and granted, stocks don't frequently double in price that quickly, but things happen, and that's why this whole idea of understanding risk and understanding, outlier events, a stock going from 50 to 100. If you're on the short call side, you need to understand, the risk you have. So short calls, limited profit potential. That profit potential is the premium you take in. Unlimited risk because potentially that stock could go up to infinity. That's the call side, long call, short call. On the put side, why buy puts? Generally, investors buy puts because they might be bearish on an underlying. They think the stock market's going down, something like that. Same concept, though. Small cash outlay, limited predefined risk. That's critically important here. Put buyer, gets the right. Any option buyer acquires a right. Call buyers get the right to buy the underlying. Put buyers get the right to sell the underlying at the strike price until expiration. And, of course, we pay a premium for that right. Let's go back to XYZ. In this scenario, stock's trading $36. The investor is bearish on the stock. So, we're interested in buying a put because we're bearish, but we want limited risk, so we talk about buying the put. We decide to buy a 3-month 35 strike put for $225 or $225. So the stock's 36. We're buying the right to sell stock at 35. So that's $1 out of the money. The way this thing looks, from a profit and loss perspective, is just like this. We've got the 35 strike, and in order to figure out your break-even point at expiration, not before, but at expiration, you take that strike price minus the option premium we pay, so that's going to be 35 minus the price of the option, 2.25. Our break-even at expiration is 32.75, so the stock at expiration is going to have to be at that point or lower in order to make a profit. So let's go through the same scenario in terms of thinking about what's the value of that $35 strike put at expiration. We know we paid a total of 2.25. So with the stock 25, does it make sense that that 35 put is worth $10? I hope it does. Again, that 35 put represents the right. We've acquired the right to sell stock at 35. Heck, if the stock's going to 25, that right's worth $10 at expiration, and maybe $10 plus some time premium before expiration. If we paid 2.25, our net profit is going to be a whopping $775 or $775 per option contract. How about at $30? Does that 35 put have value? I hope you say 5. The right to sell stock at 35 with the stock 30 is worth $5 at expiration for sure. $5 of in the money or intrinsic value. If we paid 2.25, our net profit's going to be $275. Quite a profit there. At $32.75, we know that's going to be our break-even point at expiration. Any level in the stock between $32.75 and $35 at expiration is going to be a loss on our put investment, just a question of how much. If the stock went out at 34 at expiration, what do you think the value of that put's going to be? Stock at 34, the right to sell stock at 35 is going to be worth $1. We paid 2.25, we'd be down $125 at 34 at expiration. Okay, at 35, we know the value of that put is 0. We paid 2.25. We're going to lose that whole 2.25, $225, and then anywhere above $35 at expiration, that put's not going to have any value. So again, we'd have lost whatever premium we paid. But with the long call and the long put, we've got a predefined risk going in, whatever we paid for the price of that option or options. Short put, okay, back to the whole idea of risk. Limited profit potential. Why limited profit potential? Because a short call or a short put, you can only make the premium you sold that option for. So same thing on the call or the put side. Your maximum profit is the value that you took in when you sold that option. In terms of the risk of the short put, remember, the short put, the put seller has an obligation to potentially buy the stock. Stocks can only go to 0. So we talk about substantial risk with the short put rather than unlimited risk, because stocks, again, on the downside can only go to 0. They can't go down forever. But that's the difference between the short call and the short put. Both have limited profit potential, and the short put has significant risk. So let's compare buying versus selling, and then we'll go to Nick for some questions. Buyers and sellers, each option contract has two parties. You basically have a buyer and a seller. The call buyer buys a call from the call seller, and the put buyer buys from the put seller. And every call buyer, put buyer, call seller, and put seller, they all have different motivations. Don't really worry about the other side of your trades. Focus on what you're doing and why. And if the whys change, then I would urge you to consider changing your positions. But for every buyer, there's a seller, whether it's a call or a put. Again, the terminology, long positions, long calls, long puts, short positions, writers or short calls and short puts. Now, there's another area where we talk about opening and closing a position, just like any stock position. You buy the shares of stock to open the position. You've initiated a position by buying the shares of stock. Well, the same thing is true with options. You buy an option, you're initiating a position, you open the position. On the stock side, you can sell the stock first and then buy it back. You can do that with the options as well. So the first trade, whether it's a buy or a sell, is the opening position. So we've initiated either a long or a short position. And then to close, we can, close to open or close to buy, depending on, which was the initial position. So opening and closing can be either the buy side or the sell side. And then when we talk about option buyers, they are, another term is option holders. Option sellers, as I mentioned, can be option writers. So we can buy to open and we can buy to close. We can also sell to open and sell to close. But you need a buy side and a sell side, or a sell side and a buy side, and it's going to be an open or a close. And last two comparisons, we've got long calls versus short calls. On the long call side, we own the right to buy the stock when we're long the call. We're acquiring the right to buy the stock with long calls. On the short call side, we have the obligation to potentially sell the stock. Okay? And potentially, because if we're not assigned, if that option is not in the money, or if it doesn't have any intrinsic value at expiration, that option would expire worthless, and therefore we wouldn't have to deliver on our obligation. That's why we say potentially sell the stock. Long calls can buy the stock if we choose to exercise. Short calls, we must sell the stock if we're assigned. So that gets back to rights and obligations, but we're only going to exercise our right if that option has value, either before expiration or at expiration. And that value comes with the in-the-money amount or the intrinsic value. And without intrinsic value or in-the-money value, that option is not going to be exercised. But when we exercise, the call owner has the right to exercise and therefore buy the stock. The call seller will be assigned of when the call buyer exercises. Long call side, generally we get profits when the stock rises. We lose if the stock goes sideways or falls. Short calls essentially profit when the stock falls. Oftentimes when the stock goes sideways, we profit as well, and typically we'll lose when the stock rises. Long calls, again, getting back to those building blocks of option premiums. We've got possibly in the money or intrinsic value, and then we've got time value. Well, time value obviously costs money, and as we get closer to expiration, if that underlying stock has decided to just sit still and not move, that long call is going to lose time premium as we get closer to expiration. On the flip side, the short calls will collect premium as we get closer to expiration if the stock has either just sat or gone down. On the long put versus the short put side, long puts, again, give us the right to sell the underlying stock, where the short puts potentially impose the obligation to buy the stock. Long puts, we get to sell the stock if we exercise. Short puts, if assigned, force the put seller to buy that stock at the strike price. Long puts generally profit when the stock falls, lose if the stock rises, and the opposite is true for short puts. And the same thing goes with the calls. Long put holders as we get closer to expiration, the value of that time value will shrink, so they will typically lose money in terms of time value, so that stock has to go down in order for that long put to appreciate. Short puts, if the stock's not going down, will the short seller, the option seller for the put, will take in money or profit typically if the stock just sits or goes up as we approach expiration. So just to wrap it up, the various uses for options, risk management, certainly income generation, especially in this low interest rate environment. The leverage we talk about comes from each option corresponding to 100 shares of the underlying. Improving the risk reward in investments is one of the byproducts of option use, and it allows us to diversify our portfolio with less capital as well. Remember, options are tools. They're really great financial tools. You always got to be careful and mindful of the amount of risk you're taking on, depending on your option position or strategy. You may have little or no risk or lots of risk. Important to understand that, and that just comes with additional homework. Buyers have rights, as we've said many times. Option sellers have obligations. Each contract corresponds to 100 shares of the underlyings, and options may have intrinsic value and typically do have time value, but not always. And of course, for all the options that are out there, those prices vary rather dramatically. Before I turn it over to you, Nick, just to mention that the OEP, the Options Education Program, do consider, especially if you're new to options, and even if you're not but want a refresher, we've got this dynamite MyPath assessment program online. It's a 20-question assessment. You'll fill out that questionnaire, and we'll download lessons at the appropriate lesson for you based on the results of that 20-question assessment test. So that's MyPath. I would urge you try to find the time to do that. All kinds of other offerings on the website. And as Nick mentioned, try to take a minute or two before you leave us today and fill out that survey, which is very, very important to us. And never forget, if you have questions, you can always call our investor services team at 888-OPTIONS. They're there 5 days a week for you. So, Nick, I'll turn it over to you.
Great, Joe. Thanks so much for all your time and expertise today. And ladies and gentlemen, I do want to hit home that point that Joe just made. We've got a number of great questions today, since this is a beginning options seminar that we're talking about today, that our investor services team is available to answer any of your questions, whether you're a basic or an advanced options trader. Give them a call at 1-888-OPTIONS at any time during business hours, or you can chat with them by going to our website at optionseducation.org. They're there to help you out with any options questions or transactions that you may be experiencing and should help you on your options journey. Joe, with that, we did get a number of great questions, like I mentioned, and the first one, we got this a couple times. Can options be exercised any time before expiration, or do they have to be exercised at expiration?
Real good question, as you said, Nick, and I was not specific in the presentation. There are two types of options, and in our next basic presentation, we'll hit on this. It's a really good question. Two types of options, American style and European style. Of the 4,200 plus products we have out there, the vast, vast, vast majority are American style options. That means you can exercise anytime, okay? European style options are those options that can only be exercised on expiration day. They're typically indexes. But let's back it up just a little bit. When would you exercise an option? You would exercise an option, the vast majority of the time. Clearly, when you want to, evoke your right, whether that's to buy the underlying or sell the underlying, but you're only typically going to exercise that option when there's no time premium left, because once you exercise the option, it turns out to be the stock. And so if you had both intrinsic value and time value for the option, by exercising, you would give up the time value. So there'd be more value in selling the option and taking in that additional time premium than exercising when there is time premium. That gets into maybe a little bit more as to when to exercise, Nick, but the vast majority of the listed options are American style, which means you can exercise at any time after acquiring them.
Joe, we got a number of questions about calls and puts and how they work kind of in parallel. This first investor asked, if a long call is equal to a short put, why is there the duplication? Is there something more to it, or how does that relationship work?
Well, the relationship works in something called or through call-put parity. Okay, so we talked about at-the-money options. At-the-money calls and at-the-money puts both have about a 50 delta. Okay, so the value of the call and the put minus dividend is close to the same. There's a three-way combination. It's the stock or index or ETF price, and then you've got your call and your put. And the combination of those three at all times has a value. The terminology for that is conversion or reversal, but that is what keeps the value of the calls and the puts in line with one another versus that underlying at almost all times, Nick. And that's basically how that goes.
Well, Joe, what is your criteria for buying a call versus selling a put, if that's the case?
Buying a call versus selling a put, couple different things there. Capital requirements. You need to know what the capital requirements are for your broker. Typically, they are one and the same. So, I would say check capital requirements from your broker, and as always, be mindful of the risks.
Joe, can you talk a little bit about the probability of being in the money for buying calls and puts versus selling calls or puts?
The probability, Nick, would be based on the delta. Okay, so the delta is there are a lot of different definitions, for delta, but one is the expected probability for that option to be in the money at expiration, and so if we've got a 20 delta option, and that the other definition can be that we expect if we're long a call and the stock goes up $1, we expect that option to appreciate by 20 cents. That would be a 20 delta on that particular call. And the other way to look at it would be the possibility of there being about a 20% possibility that call will be in the money at expiration. So that's really the probability side of comes in when we talk about deltas.
Joe, you talked a good deal today about premium. Who sets premium? How has that actually come up, that valuation created?
The marketplace creates option prices. So that marketplace is comprised of professional market makers, traders who, their job day in, day out is to make option prices in particular underlyings. There are institutions in the market, and then there are retail investors. And so it is a combination of really everybody, best bids, best offers. I mean, the technology allows the best bids and best offers to be shown on the various exchanges at all times. NBBO, Nick, is the terminology for National Best Bid and Offer. As an example, let's say we had an option market that was one bid offered at 105. If we as a retail investor wanted to pay $1.02 and we posted that $1.02 bid, we could be the very best bid in all the world. But price dictates. So it's a universal marketplace, and everybody's got the same opportunity to be the best bid or offer. It just gets down to price.
Joe, can a seller be assigned before expiration if the call or put is in the money?
seller of an option can definitely be assigned before expiration. They would only be assigned if the option is in the money, because if it weren't in the money, the option holder wouldn't exercise it or shouldn't exercise it. But that goes for the American style options, where you can be assigned at any time. Again, thinking about the two components of pricing, we've got intrinsic value and time value. As an option seller, you can typically expect to be assigned, and therefore, if you're short a call, have to sell the shares at the strike. If you're short a put, you have to buy stock at that strike. Typically, you only get assigned when the time premium is gone, and that happens for one of two reasons. We're very close to expiration, or the stock has moved so much that the call or put is so deep in the money that there's virtually no value left to the other call or put, and therefore there's no time premium left in the option.
Joe, we're a little bit over our time, but we do have one last question that I think we should address. We got this from a number of our investors and our attendees today. How important is the strike price?
Well, Nick, I like that question. The strike price in our examples, we talked about the $60 call, one of our first examples. Okay, the stock was 60. We bought a 60 call. In that example, we paid $3. Okay, 60 was the point where we had the right to buy the stock. If we had the 55 strike instead of the 60 strike, first of all, we know the value of that option would have been at least $5 more than the $3 $60 call, because we're $5 in the money. The 55 strike would be the right to buy the stock at 55 with the stock at 60 plus whatever time value. And then if we go to the out of the money, say the 65 call, it's clearly going to be a lot less money than the 60 call because it's $5 out of the money. But the right is at 65. Doesn't mean that the stock has to, be in the money at expiration. Maybe we're just looking for that stock to go from, 60 to 62 or 63, and we don't have $300 to buy a $60 call. Maybe the 65 call is valued for $1 or $1.25, so we get to buy one of them, and maybe as the stock goes to 61 or 62, the value of that call goes to 175 or 2, and we still get a chance to make money long before expiration just on the movement of that stock being a couple dollars. But strike price is critically important in any option strategy, and whether you're buying or selling options, it's something, to me, Nick, the two key questions, and we didn't speak to months at all, but, what month for my option and what strike for my option positions are two really very important questions that we always have to ask ourselves, whether buying or selling options. And maybe down the road, Nick, we'll do a webinar on that. What strike, what month?
Joe, thanks for your time and expertise today. Do you have any closing thoughts for our listeners?
No, I just enjoy everybody or appreciate everybody joining us, and again, just ask if they could still maybe fill out the surveys. We really use them quite a bit. So thanks for joining.
Ladies and gentlemen, thank you very much for your time this afternoon. While we weren't able to get to all your questions, as I mentioned, we do have our investor services desk ready to help. Give them a call at 1-888-OPTIONS during most business hours to answer your questions. Many of you also asked about further education. If you visit our website at optionseducation.org, you can see the Getting Started section for further reading and resources. Again, today's session will be archived and will be accessible in a few hours using the same link you used to join us today. Our webinars are also available on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. And of course, make sure to check optionseducation.org in the upcoming weeks for our upcoming 2015 sessions. Our next webinar will be held on June 23rd when we'll be talking about Greeks. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.